Okay, guys, today I have on somebody who I've wanted to have on for quite some time, and I was annoying in the scheduling process, but he was nice enough to work with me. And now we are able to have on Zack Shapiro, lawyer in the space, someone who I've followed and respected for quite some time, has a breadth of experience sort of across Bitcoin and crypto. So Zack, welcome. Thank you for coming on. Give us like a little bit of what you focus on, obviously, and then we'll kind of dive into some of the questions I had mentioned.
Well, thanks so much for having me. Yeah, as I was mentioning before we started recording, I sort of wear two hats in the crypto space. The first is I run a law firm called Reigns. We represent a bunch of different startups. Probably 80% of my client base there is in the Bitcoin or crypto space. And from a legal perspective, those are different categories. The legal questions that come up with crypto writ large are different than Bitcoin companies. And we do sort of corporate law, fractional general counsel services for startups that don't have a full-time in-house lawyer yet. We do venture fundraisers of all sorts, but including sort of token warrants, weird offshore stuff, whatever comes up. And then regulatory law, which on the crypto side tends to be about securities law, and on the Bitcoin side tends to be more about money service business, money transmitter law, and really increasingly on like what is the line between a custodial and a non-custodial tool.
Yeah. Okay. Awesome. We'll have to jump into that later. But so just to quickly, you do policy for Bitcoin Policy Institute. What does that really entail? Like, well, first of all, just I think probably most people maybe know what Bitcoin Policy Institute is. If they don't, like quickly what that is, but then also what is your kind of role there, and what does that look like in practice, like creating or helping to, design policy for Bitcoin specifically?
For sure. So the other hat I wear in the space, I'm the head of policy at BPI, the Bitcoin Policy Institute, which is a DC-based think tank, a 501c3, focused on educating policymakers around Bitcoin, why we think Bitcoin is important subject to policy. That's really the first challenge, is getting people to take it seriously and differentiating Bitcoin from, Fartcoin or Dogecoin. And then, what does good policy look like? And so my role there as head of policy is, it's really two things. It's first, what should the policy areas be for us to focus on? And sort of the two big areas for BPI right now, one is public investment in Bitcoin. We are, largely the people behind the idea of the strategic Bitcoin reserve. And then sort of, many of the different versions of that, Bitbonds, state level reserves, pension funds investing in Bitcoin. But we think that, Bitcoin is really good for Americans to have exposure to. We think it can help solve problems for policy level. And then wearing our Bitcoiner hats, we think that a lot of the sort of longer term threats and misaligned interests between sort of the state and permissionless tools can be smoothed over if we really kind of go into a sort of more tighter integration between Bitcoin and public policy through public investment in Bitcoin. The other policy area that we're very focused on is this question around sort of the line between custodial and non-custodial tools, and this almost like difficult philosophical question that Bitcoin and blockchains pose for the first time, where, it used to be the difference between a tool like a laptop or USB cable on the one hand, and a sort of financial services firm like a bank or remittance firm is very clear. Blockchains blur those lines, right? There are things that are functionally tools. They're just made out of code, but they do a lot of the same functions that a financial firm would otherwise do. And that's everything from like coin joins to automated market makers, just to give you a flavor of like how these things work. Probably we'll end up talking about the Clarity Act at some point, but absent a federal legislative framework that solves this problem, and we think the Clarity Act does a pretty good job of solving this problem, federal judges are going to have to figure this out on a case-by-case basis, and they're largely in their 70s and 80s. They're not necessarily very tech forward. Yeah. So it's a real challenge, not just on Capitol Hill, but in the federal courts around the country to deal with, if we get bad case law on this stuff, that really is an existential threat for the ability to use peer-to-peer technology in the United States.
Yeah. Okay. Good background. Now I can start getting you to hopefully give some opinionated thoughts. So leading up to Trump, everyone was extremely excited. There was a lot of hype that this was going to be the breakout moment for crypto. Since Trump was sworn in, how have we done? I say we, I'm not really involved in this, but how has crypto done? I think there's a lot of, I'm going to ask more pointed questions in a bit, but from your perspective, all this promise of getting rid of regulation by enforcement, clarity, literally and figuratively, right? Like the bill, but also just, better regulatory clarity. Like how you can rate us perhaps. Like, how do you think we're doing in aggregate?
Yeah, I think it's a mixed bag. If I had to grade it, I would say we're doing a B minus.
Okay.
It's better than just a passing grade, but there are real issues. The biggest thing is that we've moved on from the Biden administration's approach to crypto, which is antagonistic and absolutely was both, in the civil level with the SEC and the criminal level with the DOJ, regulation by enforcement, and basically announcing new rules, whether or not they made sense, by either suing people or trying to put them in prison. And so that going away is huge. Specifically, the current SEC's approach to crypto under Paul Atkins, the CFTC's approach to crypto newly under Selig is great and supportive, and they're putting out new rules and no action letters, and that's terrific from the executive branch. Similarly, in the DOJ side, we got the Blanche memo from Deputy Attorney General Todd Blanche that said they're not going to go after developers who create privacy tools just because of how their users use them. So those are huge. And just that about face is really big. I don't know how much credit you want to give to the administration for this. The other really big shift, I think that started more in early 2024 is Wall Street's embrace of Bitcoin and crypto is very different. And I think removes a lot of the career risk and has made our policy job a lot easier. People take, Bitcoin and blockchain technology more seriously than they used to. They understand there's a there. It's less in your face than like AI is right now. But I think getting TradFi more interested in the space has been helpful and really has helped sort of move the Overton window on what this technology is. There's some difficult conflict of interest stuff, I think, on the other side of the ledger that's sort of made the policy work harder, especially working with Democrats. I think a lot of them look at the president's family's involvement in crypto projects, and it makes them less eager to be supportive of clarifying legislation. Our point that we try and make to them is like, Trump family also owns a lot of real estate. We wouldn't, want to make bad housing law just to make sure that they couldn't make money. And so this, even if you're concerned about Trump coin and Melania coin and World Liberty Financial, that's, crypto is still here and we still need to make good laws around it. So I think that's been a challenge. The Strategic Procurement Reserve, on the one hand, has been terrific. The fact that we've not yet found a budget neutral way to acquire Bitcoin that we've been able to get the administration to do is a little bit disappointing. But we're still working on that. So overall mixed bag. I think the Genius Act also, I have mentioned getting that passed into law is great. I don't think the Genius Act really does all that much to have stablecoins work differently, but it does really two important things. One, I think it combats Tether FUD, which I think is largely FUD, but I think a lot of people in DC and on Wall Street really had this, in their head that Tether specifically is a house of cards and was going to collapse, and having sort of Genius Act compliant stablecoins that have to be backed one-to-one, I think gives people who would otherwise be hesitant to interact with stablecoins comfort, but really more sort of firms than people. And then the fact that it was passed into law on a bipartisan basis that a future administration can't just undo, I think also allows fintechs, banks, asset managers to get more comfortable with stablecoins and have sort of longer term regulatory clarity that's not just dependent on the goodwill of one, pro-crypto administration. I'd say the B- gets bumped up at least to a maybe even a B+ or A- if we get the Clarity Act across. I think that's really important. It's both important, of course, in terms of the, evergreen fuzzy legal issue of what's a security versus commodity, which is an existential question for anyone who's launching a blockchain project. But, nearer and dearer to my heart, it's also incredibly important to define the line between what is a sort of non-custodial tool that allows people to interact and transact with each other on a peer-to-peer basis with just code in the middle, right? This is what the whole blockchain revolution is about, is disintermediating third parties, and then third parties who are regulated under the Bank Secrecy Act. And if we're going to be, as the president says, the crypto capital of the world, we can't be a country where software developers fear going to prison because of what other people might do with the code they publish.
Okay, on the Clarity Act. So right now it is still in limbo. What do you make of this? Also, I'm going to say this, and then you can respond however you want, because I know that it's very delicate up where you are in DC in terms of what you can say and what you can't say. So I don't want to put you on the spot, but what it appears right now is that there are some, Coinbase specifically is being very adamant about this stablecoin yield thing. And a lot of so part of the problem, and I tweeted something about this the other day, and then somebody responded like, is there an unbiased perspective as to what is occurring with the Clarity Act right now? And I have attempted research on this, and such is the case with the history of crypto. It's very, very difficult to figure out like real incentives. Like even if you think someone is being very pragmatic and perhaps working off what we like to think of as first principles, oftentimes there are biases that are just very difficult to expose. So all of this is to say that it is hard from the outside to parse what is going on with the Clarity Act. I don't have any like people that I have to, appease really. So I can just say that Washington to me seems like it was all about getting rid of Gensler. And then the second that happened, it turned into like, we need to cut the throats of all of our competitors immediately so that like this very small kind of like sliver of, be it interest or trading fees or whatever, like is directed towards us. And it doesn't seem to be very, very cordial anymore. So on that note, like to the extent that you want to talk about it, like what's going on with the Clarity Act and what's your kind of like personal view?
Yeah, I'm happy to give you my honest take. I want to start with two disclaimers. One is, I probably will be a little bit critical of Coinbase. I think in general, they've done great things for the space, and the political power they brought to bear with the Fair Shake Pact was very important for the vibe shift we've seen in regulation. The other sort of disclaimer to start with is, so the Clarity Act is, we're going to talk a lot about stablecoins and yield. It's really not about stablecoins at all, right? There was
there's a lot more to it. Yeah.
The previous law that was about stablecoins, the Genius Act. Clarity is really about, two important things. One is the sort of which financial regulators are in charge of which types of blockchain activity. And the most important thing is if you're issuing a token, is it treated as a security or commodity? There's not really a way to have blockchain-based securities trade with retail investors. So you can't really launch a public token legally if it's a security right now. There's a safe harbor and Clarity that makes that easier. And it basically legalizes crypto VC in a way that's otherwise hard. And so that's really at the heart of it and clarifying sort of how do you legally launch tokens. And then there's a part of the law that was taken from a different law called the Blockchain Regulatory Certainty Act, which is the part that we're very focused on at BPI, which is about protecting developers, which I sort of mentioned a few minutes ago. However, going back to last summer, when the Genius Act, which is the stablecoin bill, was passed, banks started to really, I think, care about crypto deeply for the first time because they're looking around at stablecoins. And banks know what it's like to go into a bank. It's a nightmare. I don't know if I'm allowed to swear on a podcast, but it's really bad to walk into a bank and wait in line and deal with people, and they don't give you any of the yield that they make on your deposit. And God help you if you have to send an international wire transfer. And stablecoins are just better UI in almost every sense. They, theoretically, they can give you much more of the yield because their margins are smaller. They're not regulated in the same way. There's not the same expensive brick and mortar infrastructure they need. They work on public blockchains. They can move, instantly and for free at the push of a button. You just need a smartphone to be able to use them. And so banks, I think, got pretty worried about deposit flights to stablecoins. And so they lobbied very hard to get into the Genius Act a prohibition on the issuers of stablecoins, firms like Tether and Circle paying yield or interest on stablecoins. Apparently, no one in the banking lobby had gone on Coinbase, though, and realized that they had not sufficiently banned third parties from paying rewards on stablecoins that are sitting there. So, yes, it is true that Circle cannot pay you yield on USDC, but you can put your USDC in Coinbase. Circle pays, I think, still more than half of their top line revenue to Coinbase. Coinbase will pay you rewards, and it's kind of the same thing. It's just a partnership where Coinbase is the distribution. So now with the Clarity Act, even though that bill is not about stablecoins, the banking lobby came back for their pound of flesh and they said, okay, we're going to close the loophole and say no third party yield or interest on stablecoins. In the meantime, this has become a very important part of Coinbase, specifically their business model. And the banking lobby is very powerful in DC, has been there for a long time. They have the hold of people and, a lot of people in both parties, but including Republicans that are otherwise supportive of the Clarity Act. And, they basically got that as a provision in the Clarity Act. And in response, Coinbase withdrew its support and said, listen, we can't be held hostage on this. Whose fault is that, right? I think it's a little bit of a pox on both houses, right? Like from first principles, Coinbase is correct that this is just naked protectionism from the banks. There is no good principled policy reason not to allow Coinbase to pay yield on USDC. Like that absolutely should be allowed. On the other hand, this is the shot we have to pass badly needed, bipartisan crypto reform, right? Like if we have a different administration, if we're Democrats in 2028, we're going to be really kicking ourselves if we don't protect developers and we don't clarify, when our token securities versus commodities. And so dying on the hill of stablecoin yield seems to me really short-sighted, even if they're like right on the merits. And just like if we're being really pragmatic about it, like, let's say there's a less friendly administration in 2028. If you get people used to using stablecoins and you're like, hey, we'd like to amend the law so you can earn yield on your stablecoins, that seems like politically pretty popular. If we don't get comprehensive crypto legislation done, and maybe people earn yield on stablecoins, and in a Democratic administration, like you want to do all this comprehensive, like deep crypto stuff, and everyone's, the Democratic administration is prosecuting people for crypto corruption and this and that and meme coins and DATs, we're not going to be able to get legislation like this done. So I just, the higher good to me seems like, the banks are a bad actor here, but they have no incentive to walk away. Whereas I think Coinbase maybe needs to, cut its losses.
Why is Coinbase walking away the in boss? Like, why is that? What do we need Coinbase to co-sign on this? Like, something to me indicates that Coinbase is so very powerful that if they are to walk away, for some reason the bill is, torn up or something. But who cares? Well,
so we don't want the bill torn up, but why is
right.
Why is Coinbase so powerful? Part of it is, the Fair Shake PAC, right? They donate to a lot of different legislators. They are seen as sort of the US champion. They're the most famous public company. They were the first big public crypto company. And they could walk away and you wouldn't lose all of the Republicans, but you would lose some of the Republicans who are maybe more loyal to the sort of, or listening more to the banking lobby than to Coinbase. The dangerous thing there, so either the bill would just fail because of that, right? Because the Democrats don't want to sign on to this bill because they don't want to endorse crypto when the president is, allegedly enriching himself. And, they hear all the other FUD items from Elizabeth Warren. The dangerous thing I'm particularly worried about is that, okay, if Coinbase doesn't full-throatedly support this, we lose some Republicans, we have to win over some Democrats. And then is the trade here, we get the securities versus commodities thing fixed, but they throw the developer protections out the window based on like national security FUD. And so that's something that we're keeping like a very close eye on. That's like 2 steps ahead in the sort of chess game here. But that's another reason why it's really important to have, like, Coinbase understands the developer protections. They've been very vocal in support of that. If we lose them and everyone else is sort of scrambling to make a deal, I worry that deal gets, at least for, as far as Bitcoin is concerned, worse than no bill.
Okay, so yesterday, this is being recorded on Friday. It will come out on Sunday. Yesterday, so Thursday, I see this tweet. Again, I was scrolling and I didn't do any due diligence on this, but I see this tweet that says Trump demands that you guys need to get in the room and work it out or something like that. So then now, like, kind of current events, now that we have context, what maybe percentage likelihood do you ascribe to Clarity passing in its current form? And then also, did anything come of Trump telling banking lobby and stablecoin yield desirers to get in a room and work it out?
Yeah, it's hard to tell. I wasn't in that room. Both sides put out statements that seem great and optimistic, but maybe not the most substantive in the world. I think
classic
White House,
DC.
Yeah, the White House does want to make a deal here. Like, I think they are, like, the White House is looking at the same price charts we are, and they're like, really, it would be great to get something going. But I just worry that the incentives are not great. So, like, gun to my head, what do I think the likelihood? I think it's like a roughly, maybe a little bit better than a third chance.
Okay. Let me take a moment to talk to you about Ellipsis Labs, a team I've known for a while. The Ellipsis team is one of the few that I consistently point to and say, these guys really know what they're doing. Ellipsis Labs brought capital-efficient order books to Solana and started the Prop AMM revolution with SolFi. Altogether, they've saved retail traders tens of millions of dollars by reducing slippage on spot markets. They're bringing the same level of expertise to perpetuals with Phoenix, which is live today. Ellipsis Labs is backed by Paradigm, Electric Capital, and Han Ventures. I would consider them the foremost experts in crypto market microstructure. The best part is that Ellipsis Labs is hiring for New York-based engineers. Work with a small, focused team who are results-driven, collaborative, and use a modern stack. If you're an engineer with a DeFi team that's already proven itself in the market, go to ellipsislabs.xyz/careers. The commodities versus securities obviously has been like one of the talking points since, well, really the inception of crypto. What is the what is the big breakthrough here with delineating this and maybe the, improvements going forward from your perspective and also from the Bill's perspective?
Yeah, it's basically a safe harbor, right? If you're launching a token, so probably you've covered this on your podcast before, but like the big scary thing for all of crypto is the Howey test. The Howey test are these 4 questions you ask about a sale of an asset to determine whether it's a securities offering or not. The 2 ways you can realistically, quote unquote, win on the Howey test are either to claim sufficient decentralization that you're not reliant on the efforts of any particular group of people, or to claim that you're selling basically a consumer product and not an investment vehicle. It's that you're selling a quote unquote utility token. Both of those arguments are really hard to make for like early stage crypto startups. The utility token argument is hard to make because the infrastructure isn't fully built out or being, totally utilized when you launch the token. And so people are speculating that the token will have utility in the future more than buying it for its consumptive utility today. And the decentralization argument is sort of, for obvious reasons, really hard to make for early stage startups just because the token supply is really concentrated, especially in our just horrendous, low float, high FTV era. And being able to have like a break for a couple of years from having to worry about that while you build out the infrastructure for the utility, while you actually build out the decentralization by diffusing the token is super helpful if you're a crypto founder or crypto VC.
Yeah. So like when you say safe harbor, my understanding is that this is sort of a period of time where they're going to let it slide and they reevaluate in the future though. Yep. Is that correct?
Yeah.
Okay,
but then you have time to build out the utility or time to build out the decentralization. So hopefully by then you pass the Howey test.
Okay, so then when you say hopefully by then you pass a Howey test, like how would that apply to, for example, a utility token where like you're saying it in its current form, people are, well, like 99.9% of people are speculating the future utility. What at that point delineates the utility? Because I have heard, the reason I ask is because I have heard some like interesting, percentage of token owned by insiders. Like there's actually some demarcated percentages, which is like kind of bizarre from my perspective. You can distribute tokens to various other entities, right? And like we've seen this all the time with DAOs, for example, that are all sort of like, shell companies of shell companies and so on and so forth. But what are those sort of like in the future, for example, with the utility token? What does that look like in practice? And like, how would you be designated that versus,
yes. So it's not really a bright line test. I mean, you can look at the metrics and make your argument, but really it's as a reasonable purchaser, the hypothetical reasonable man you learn about him as a first year in law school. Is that person more likely to be buying the token for consumptive utility or for speculation? And there are all sorts of things people buy for both reasons, right? Rare sneaker drops. Some people buy them to wear them and show off. Some people buy them to flip them. They can have both attributes. The question is this thing look more like a product or more like an investment vehicle?
Yeah. Okay. In terms of the developer, like a lot of the protection of developer rights, what kind of does Clarity say about this? And you seem quite like keen on this. I think this is likely because you are, lean on the Bitcoin and Bitcoin policy side. So I think this maybe has a bit more bearing on what you're passionate about, perhaps. What are these kind of like developer protections?
Yeah, this is the part that matters most for Bitcoin, but certainly does not matter only for Bitcoin, right? This is absolutely critical for anything in DeFi. It is the thing that makes DeFi DeFi, right? The reason why you don't have to necessarily KY people on a decentralized exchange is because, decentralized exchanges aren't really exchanges. They're smart contracts that allow people to exchange on a peer-to-peer basis. Similarly, we had, Bitcoin developers now in prison for creating a tool called Samurai Wallet, which was just a wallet that allowed people, it didn't take your Bitcoin, it allowed people to spend their own Bitcoin in a way that preserved their privacy. It's just a piece of software, right? Some people who want privacy are criminals. Some people who don't, want privacy are not criminals. We don't normally hold Apple responsible when someone uses a laptop for crime. And, if the law is interpreted that way, it has an incredible chilling effect on people building in the space. So I think that's really important. The way that the Clarity Act draws the line is if you're what they call a non-custodial developer or service provider, meaning that you do not have independent and unilateral control over other people's assets. The unilateral part's really important because it protects federated and decentralized institutions, right? DAOs, big enough multi-sigs, right? You don't have independent control. Then you're not deemed to be a money transmitter. And so you're therefore not criminally liable for, not KYCing, AMLing, following the Bank Secrecy Act like you otherwise might be. So
that seems like a pretty big deal. You go back 5 years and crypto is under assault or whatever, and there's all of this, particularly around this subject specifically, like privacy and the ability for, developers to write permissionless software that they don't control. 5 years ago, if you could design the optimal legislation or regulation around this, how close are we to that with this specific point in the Clarity Act? Like, are we mainly there? Would something like Tornado Cash and Samurai now be allowed? Because the last thing I would say is, like, a lot of my interpretation and the research I've done on this is that, unfortunately, like mixers and stuff like Tornado Cash can still very much be interpreted, even, protecting developer rights, even it's still like almost up to these judges when cases are brought. And that's what's sort of scary. So I'm curious, like, how close are we to what you would think of as like optimal design, perhaps?
Yeah, so I think it's a really complicated question. So a bunch of different things. So I actually think the best interpretation is the law as it stands today, even without the Clarity Act, is similar to what the Clarity Act says. Under the Bank Secrecy Act, you have to KYC AML if you're a money transmitter. A money transmitter is a business that accepts and then transmits funds on behalf of the public. I think ordinary language would suggest that if you accept something and then you transmit it, somewhere in between those two things, you need to be in custody or control of those funds. Otherwise, how can you accept it and then transmit it? Towards the end of the Biden administration, there were these two prosecutions, one against Samurai Wallet and one against Tornado Cash, where the government took a incredibly expansive theory that what money transmission means, to say that you don't need custody or control over customer assets, which neither Tornado Cash nor Samurai Wallet had. You just need to be involved in the facilitation of users transmitting their funds. Now, again, that's a perversion of the language, right? Like, in a peer-to-peer non-custodial tool, the users are the money transmitters, not the person who built the tool or provides infrastructure like a front end or UI around the tool. It's the users are doing the transmission. But, in the reply brief, the government's reply brief in the Tornado Cash case, they say, well, the word transmit doesn't really imply that you're, in possession of something, because a USB cable transmits data and a frying pan transmits heat. Those are the real two examples they really used. And neither of those imply that the frying pan was in custody of the heat or the USB cable was in custody of the data. And, there's just no limiting principle to that, right? Like, I think their argument goes too far, and it really would make the maker of the USB cable maybe liable for people who use it in crime if they transmit funds, right? Like, by that logic, the company that like chops down trees to make the paper that makes an envelope that one criminal used to hand cash to another criminal is a money transmitter because they didn't KYC the people who use their envelope. Like, it's just total silliness. And in the previous administration, like, it made sense, because if you have that lever to go after developers, right? They were, I think, genuinely, I didn't think this came from a place of trying to ban crypto, but they definitely were concerned about money laundering using crypto, and they didn't really care about collateral damage. And so they brought these cases. The problem is when judges take that stuff at face value, which is more or less what happened specifically in the Tornado Cash case, it can amount to a ban on actually creating crypto tools. So anyway, so that's like the state of the law. I do think that the Clarity Act would make that line very clear. Now, the trade-off in the Clarity Act is that there is KYC regulation on front ends. I don't think that should be the case. Front ends are non-custodial. But so, like, in the specific Tornado Cash case, could the government have made a theory based on the relayers on the front end? Probably not, but maybe still. I think Clarity would have, to me, very, very likely protected the Samurai Wallet devs. Now, maybe to preview where we can go in a bit, my view is that specifically with privacy tools and probably with crypto in general, front ends are just going to be way less important in the age of agentic tools. And so, and privacy tools, I think, are about to get way, way more powerful. And there are going to be interesting, novel legal questions around, okay, like if my, Multbot sets up an eCashment, like, whose responsibility is that? That's where we're headed. There's no way the law is going to catch up to that. And so, like, that to me is the bigger story of like where this is all going. And, God help us when the federal courts have to sort that stuff out.
Yeah, that's really interesting. Okay, well, actually, let's go into that. Like, what is your sort of perspective there with that? That's quite interesting, right? Like, maybe we're all using some, version of a ChatGPT app or like an agent, and it is doing stuff on your behalf. But yeah, that's fascinating. This this saying agents can't, AI can't get bank accounts, but this is now the more like perhaps interesting aspect of that. How do you think that will be interpreted? Like, maybe just at a broad level.
Well, before we get to the legal part, I just want to say, I think the sort of wide scale crash out that's happening in the crypto space right now, where people are quitting, this is like the worst possible time. I really think that, like, looking at, I am definitely like a diehard Bitcoin person, been very skeptical of the rest of crypto finding any product market fit yet. But this AI stuff is an incredible shot on goal. All of the stuff that was like fake, right? Like, DeFi was mostly people gambling. DAOs are just way worse than a Delaware C Corp. But like, okay, but they're permissionless and they're purely digital. And so that's, of course, what the agents are going to use. And
okay, like I agree with you. With that said, a lot of the crash outs are a function of people who have invested primarily in grossly inflated tokens that don't need to exist, will have like basically zero marginal demand in the long run. And so it's natural for them to have created a vision in their mind of where the value accrues, who ends up holding these tokens. A lot of their perception around this is being, those crash outs are reasonable from my perspective. If you hold an astronomical amount of high FTV, low flow tokens, and you're realizing that the agents will not demand this, yes, I think that
of course that's what's happening, and maybe the right answer to that is like good riddance.
Right. Oh, I agree.
But I wouldn't say that that's reasonable. I would say is like, listen, if you were just here for the, printing token number go up thing, and you didn't believe any of the stuff you said about what this technology can do, like, man, you really missed out on like the people who use this tech to actually add value. Like the A part of DAOs was never a real thing. Now it can be. That's super cool. It's really cool from a business and tech perspective. It's also going to be really cool from a legal perspective. So I just think like what's coming is going to be really fascinating. And, I think it's both like true agentic use of these tools, right? Like machine to machine commerce, but also, even short of that, already I've found like in my work, as a lawyer used to spend 46 hours a day in front of Microsoft Word. That has been drastically cut down because, Claude can manipulate Microsoft Word. So I can sort of figure out the edits I want and it can do the red line for me. And like, using Claude Code, it can manipulate websites and web apps. And, in the Tornado Cash case, there's all this stuff about no one would ever use the Tornado Cash smart contracts directly because it's so hard. They had to go through the UI. Well, that's just definitely not going to be true anymore. You're just going to tell Claude, like, make sure my ETH is private, and poof, it's private. Like, that's an incredible step change in the usability of blockchain tools. And so I really do think like outside of the, Bitcoin space, like this is, the Web3 stuff really might come true now in a way it hasn't yet. So that's really exciting. But agents don't have legal personhood. I would say the other part of being a crypto lawyer for the last, a better part of a decade, I feel like I'm really well trained for some of the questions that are to come, right? So like one of the big questions the law is going to face, not necessarily just in crypto, is like agents don't have legal personhood, but they're going to do stuff, right? They might commit crimes. They might incur tax bills. They might be worth a lot of money. They might raise money, right? They could issue tokens to fund themselves to do stuff they want to do. And there's going to be a question of like, they're not a legal personhood, so you can't really sue them. They don't have, it's going to sort of be decoherent. Well, this is the same question we've been facing with DAOs, right? Like purely on-chain institutions also don't have legal personhood. Now, it's a little bit of a different situation, right? With DAOs, the particular danger in the United States is the default. If you have a bunch of people form a DAO and you don't have any kind of legal entity and you get sued, the default is you're a general partnership and everyone is personally liable. So that's no good. And so like crypto lawyers have spent years and years now coming up with what are called different legal wrappers for DAOs, right? Whether it's a Cayman Foundation or a Wyoming DAO LLC or a Duna or all these different, attempts that either are the DAO or are an entity that legally represents the DAO. We're going to have to think of stuff like that for agents, but having these things that act like a person in the world but are just code, that's gonna break our laws. I mean, I don't mean break our laws, and it will violate our laws, but also it's gonna break the concepts embedded in our laws.
That's interesting. I wanted to come back to the front end thing because I think this has been a subject I've seen talked about like relatively recently, which is interesting because like 2 or 3 years ago it was a oft spoken about subject, and then now recently I've seen this resurface. What is the kind of impetus for this? So I've seen this in the context of Hyperliquid, for example, and I think they probably have some incentives there. What is the kind of front end thing that's going on right now, maybe? And then I don't know if this is relevant to the clarity. I assume in some capacity it is, but like, what is the front end discussion that's maybe going on?
Yeah, front ends have some. They're not fully subject to the Bank Secrecy Act, but they have Bank Secrecy Act like requirements to, in some cases, right? If they have certain functionality, they could be regulated as brokerages, although they can sort of largely escape that if they're structured carefully. You have to make sure that you're not dealing with sort of sanctioned addresses or sort of known dark web wallets. And so the law presumes that front ends have capabilities because they are created by companies in a way that like a smart contract can't be regulated in that same way.
Okay.
And then, I've called this before like the DeFi mullet. It's sort of like regulated in the front and then DeFi in the back.
So I think your argument, and then obviously the crypto industry's argument, is that the KYC should not be implemented on the front end. How is this going? Like, how is this being conveyed currently to legislators? Like, do they seem to push back on this, or is just like, are we making positive strides here?
Yeah, again, it's not a full KYC regime that's required.
Okay, but what does it look like then?
It's you have to basically install a chainalysis software, right, and reject certain transactions, and we don't know the full extent of that yet. Some of that is going to be up to Treasury, but at the very least, you have to do OFAC sanction screening. That's something that, like, my view is people, including front ends, have to do already, right? Whether or not you're a money transmitter, whether or not the Bank Secrecy Act applies to you, OFAC applies to everybody. Now, that's a pretty low lift compliance burden to just make sure you're not, sending money to the specific Iranian or North Korean wallets. That's not such a big deal. The Treasury piece of this, right? Like, there is more authority to also designate dark web wallets, drug trafficking, other bad stuff. We'll see how far that goes. We won't necessarily know that day one when clarity passes. But the point is, there is a distinction drawn between the underlying back-end infrastructure and the front ends.
Moving off that, and this kind of goes back to like the agent / personhood aspect of it. How do you think the nation state, maybe we'll phrase it like this, how do you think the nation state currently views, for example, hitting hyperliquid smart contracts with OFAC or dark money or whatever it may be? There's been accusations in the past. Also, hyperliquid, I think, has done a decent job, or they say they have. I'm not really maybe I shouldn't speak on that. But regardless, maybe they do kind of like, circumvent this front end. How do you think that either in its current form or going forward, you could have Iran trading $100 billion per position through, a cloud code, Moltbot?
I think probably the way this shakes out, and this is something we've talked to both U.S. and foreign regulators about, is something like a distinction between territorial waters and international waters. Maybe this is the best case. Maybe it's worse than this, but I think the equilibrium is something like pure DeFi. You can't really regulate because it's immutable and on-chain and on censorship-resistant networks. And so it is what it is. If you're going to be a regulated financial institution, if you want to touch the sort of like onshore markets in a country that has its own crypto regulations, then there are going to be certain regulations to come into that specific economy. And the interesting sort of like topography here is going to be in our analogy, like what are the ports? Where's the line? Famously, like I find the history of prohibition super interesting. And 3 miles out from the east coast of the United States during prohibition, you had all the rum runners, right? There would be the boats that would get rum, and they'd sit there, and then people would bring the rum in, but they were into international waters, so it was harder to go after them. And I think the candidates for this it's going to be some sort of DeFi thing. One interesting like piece of technology I think that straddles this might be vaults. In my practice, I'm seeing increasingly like vaults are the things that TradFi seems to be most interested in, right? The big firms that are going to be regulated kind of want to get into the like vault curation business. But on the other side of vaults might be truly permissionless lending markets that are just mediated by smart contracts. And so, is that line in international waters basically like the, line between like Morpho Part 1 and Morpho Part 2? Like maybe, is that line going to be something with the Genius Act, right? Like the OCC, the U.S. banking regulators, able to basically, pull the card of a stablecoin issuer of coming to the United States if they're not following judicial orders or basically what the what the executive branch tells you to do. And so it could be that like we're, there might be Tether out there, and open DeFi doing stuff that we wouldn't allow, but if it's going to touch U.S. persons, they're going to hold Tether's feet to the fire on that. But there will be hyper-regulated sort of crypto as a back end for finance. I think that's a very high conviction on that. There will be pirate dexes out there that are just purely code that maybe people are using open source AI to interact with and Tor and all that stuff. And the in between is, I think, what's interesting, but maybe harder to imagine exactly what that is right now.
Yeah, I wanted to touch on, and I had this discussion. I actually kind of had this discussion. I had Hester Peirce on, and I tried to convey something that I felt for quite some time, which is that a lot of the supposed ideals in crypto, a lot of what we hold to be, lines in the sand, perhaps, don't necessarily matter from a regulation perspective. And I think this is something that a lot of people have had to come to terms with, including myself to some extent, mainly because I don't know the law. But for example, when it gets into the actual technical components of this, and I keep bringing up Hyperliquid, obviously, because it's one of the most, popular projects right now. Hyperliquid is, a lot of what goes on is verifiable on chain. With that said, it is closed source. The validators are effectively given a binary and they don't really know what goes into that. My question is less on whether or not that should be allowed or what that entails, and more this type of thing. I'm not super technical, but I try to understand what's going on, perhaps. This type of stuff matters to us, maybe, and we understand the delineation between a truly open source, I don't know, Uni V2 or something like this, right? Where it's completely verifiable on chain versus, okay, well, clearly there's some nuance to how Hyperliquid is operating, maybe its validator set. How much of this stuff, this what I'm bringing up right now, how much of this stuff actually plays into when you're talking to regulators, when you're talking to legislators? I know you have to kind of dumb it down. I know they have a lot of different things that they have to deal with on a daily basis, but this stuff does seem quite relevant. But then I don't know how much of it comes through with the people you talk to, or to the extent that it's even conveyable.
I think there is some dumbed down version of this conversation that is happening in DC. I think people understand that there are sort of difficult lines. It certainly comes up in my practice when I'm advising clients, right? If you have a validator or a sequencer set and you're trying to figure out all right, is this money transmission? Is there a relevant sort of entity here that controls user funds, right? Either custodies or has the ability to control and unilaterally send user assets wherever. If it's a single sequencer, and they can move your funds wherever, well, okay, that kind of looks like money transmission. If it's a broad federation where no one has control, you've got a much better argument. And so from a legal perspective, it matters a lot. From a policy perspective, it becomes a difficult line drawing exercise. And Clarity does a pretty good job talking about sort of unilateral. But yeah, I mean, ultimately, we have stricter regulations for financial firms that you give money to and they are in charge of your money than we do scaffolding or tools. And I know we've been talking a lot about that, but that is, I think what you're describing is a flavor of that same question.
Do you suspect, again, you don't have to answer this if you don't want, but do you suspect that the newest, I don't know if you saw this, but Base is moving to a different, let's just say different model? Is this because of, obviously single sequencer before? I think they're maybe trying to decentralize it to some extent, with closer to a federation. I didn't know if I actually read the whole blog post, but that's my understanding. Do you think that this is a result of the single sequencer thing? Because that,
I have no idea. I'm not aware of what's happening with Base, but Coinbase clearly has very smart lawyers, and this topic would not have escaped their notice.
Yeah. Okay. I won't make you name names here, but I have another question. Like I was saying right at the beginning, where it really did seem that the entire goal was to get Gary Gensler and his draconian regime out. Okay, so we did that. Afterwards, it seems like a lot of people disagree on a lot of things. We see the VCs going after each other, right? A Paradigm A16Z apparently had a very big disagreement about the designation of a security, which is interesting. We see the exchanges going after each other. What do you make of the overall ability to come together? And do you see a lot of infighting? I have heard, I won't say names, not because I'm scared to, but because I actually don't know if it's true. But I have heard that there are groups that are very much lobbying against other groups for very specific technical things, like we were mentioning before with Hyperliquid, and saying that's closed source, that's a binary, or maybe talking about single sequencers and saying you need a decentralized validator set. What's the vibe? I mean, again, I only see this from crypto Twitter, right? So I don't know, but I think it looks like, everyone's pretty, at each other's throats now.
Yeah. I mean, definitely there's some of that going on. I guess one that I'll just use an example because I think it's pretty out there in public. And, I think one side of this is clearly a bad actor. Since 2018, we talked earlier about the Howey test and centralization. this is not something that like the concept as it relates to crypto came from a lunchtime talk that a SEC director named Bill Hinman gave that is now famous, and the Hinman doctrine of you can become sufficiently decentralized. The speech he gave was called "When Howey Met Gary," and so Howey is the Howey case. Gary is this case, Gary Plastics, that's from I think the 70s, and way predates crypto. But the idea that like something can morph from being sold as an investment contract to not is something that actually should be super intuitive. I collect whiskey. I'm a big whiskey fan. If you're buying like the right to own casks of aging whiskey in a distillery, and you don't get to drink that whiskey, but you're reliant on the distillery to age it, bottle it, market it, and then give you the cash, even if what you're technically buying is the barrels of whiskey, that to me feels a lot like investment contract, right? In fact, there's a case more or less about that. That doesn't mean that same liquid, when it's in a bottle in a liquor store, is a security. You're buying it to drink it at that point. Things can morph. I actually think that there's a very good argument that like Ethereum is like a very clear case if it's gone through this morph, right? If you bought ETH in the ETH ICO, that was probably an unregistered securities offering, because if you were going to make money on ETH, you were reliant on Vitalik and the Ethereum Foundation to like make it work. I think if Vitalik were to be hit by a bus tomorrow, like people would still build on ETH, right? There's enough activity, there's layer twos, there's capital committed. And so like a bet on ETH is not a bet on Vitalik in the way that it once was. Ripple wants to maintain more or less a centralized system where they have their company token, and they really don't like this idea of Hinman style decentralization. And so they have been lobbying really hard to, go after this concept of like, here is how you decentralize over time and solve your sort of securities law test. Whereas like, if you look at like Andreessen Horowitz, they're, they are at least out loud, they're sort of more decentralization maxis, and they believe like this is the way to actually create non-securities over the long term. And so you can definitely see divisions like that. One clear one is just the stuff Ripple puts its hands on, right? I mean, like we saw that with the strategic Bitcoin reserve, where the reporting is that they hired a lobbyist to get someone to get Trump to tweet about it. And, it was Ripple and Cardano in the reserve, and they added Solana just to make it look more credible. So yeah, there are different types of crypto policy actors in DC is a long-winded way of saying that.
Okay, good answer. Like in terms of, advising clients, and how much do you think legal work is changing, and maybe specifically with regards to startups? And, I'm sure you wouldn't advise somebody trying to launch a token project now to rely entirely on Claude for their legal advice, but where do you see this kind of going?
Yeah, I mean, it's a huge difference. I have automated a lot of sort of the back end of my own practice. My workflow, a lot of the stuff that I would have hired an expensive person for, AI takes a first cut, right? It's usually not good enough that I could hand it to the client as is, but a first cut at a research question where I have Claude doing sort of multi-agent research in parallel to like get me an answer and cite sources. Pretty awesome. Taking a first pass, I've built a whole library of custom skills based on sort of what I think are important in like contract forms. And it takes a first pass at like, what should we edit or try and negotiate in a contract? And then I'll review it and I'll tweak the red lines or whatever. But like, it's really good. It's as good as a expensive human that I could hire to do that job. And so that for law firms is really impactful. And look, I'm a tiny law firm. I can just do this. It's going to be harder to proliferate in bigger firms. But like, I would be surprised if 2 years from now, I am charging by the 10th of the hour, which is like the legal standard, just because that's not going to be representative of the value that I deliver. And it aligns incentives very poorly. Like if I can, as a lawyer, be much more efficient and deliver not just as good, but probably better work product, because I'm having this extra set of eyes that work differently than an experienced human, that's great. It's just going to have to be sort of like subscription or project-based pricing rather than like we're charging for human labor. So I think that's great. It's probably pretty bad if you're a junior associate at a big law firm. If you're in that position, or if you're a lawyer, like you really should learn how to use this technology. I published this week this like long Twitter article called "You Should Be Centaur Maxing" about the idea of like learning how to use these tools correctly and what they're good at and what they're not. I think that's just an absolutely essential skill set, I guess, for anyone sort of in the white collar labor force, but very, very much including lawyers. Now, there's other sort of mixed stuff for lawyers. Like it's very easy to file a demand letter or file a lawsuit. I've seen Vibe litigating. I've seen some unscrupulous lawyers who, are basically putting their name on ChatGPT briefs that their clients wrote, and Like that's unethical. That's very hard to prove. And so, paradoxically, there might be some situations where we need a lot more lawyers just because of the crap that's going on. Then when you get over to like the Moltbot stuff, like, oh my God, the cybersecurity nightmares, the like complex legal questions you have, like that's going to keep lawyers employed, for a long time too, who can sort of understand that stuff. Now, beyond that, like, I think you were also asking about sort of self-serve, like AI legal help. The honest truth is like using AI as your lawyer. I mean, it's better than nothing, probably. I mean, you shouldn't put too much stock in the advice. We got a court ruling, forget if it was early this week or last week, from Judge Rakoff, who's a judge in the Southern District of New York. This guy who was a criminal securities fraud case, was using Claude to prepare for his defense. He like had this idea for how to structure the brief. He sent it to his lawyer, and the government just subpoenaed Anthropic and said, give me all the files from Claude. And Judge Rakoff ruled, Claude is not a lawyer. He gave this information to a third party, Anthropic. He didn't have an expectation of privacy. He gave it to his lawyer after the fact, but this wasn't created by, or his lawyer didn't tell him to do this. And so it's not privileged. And so the important thing also to understand, if you're doing anything like talking to AI about legal advice, that isn't privileged. You have to assume that someone could sue, or the government could just get all of the, the logs of that. And so that's a big downside versus using a lawyer. But, I have a project. I vibe coded a website called venturecounsel.ai, and I'm just like playing around with some tools, and I have all the disclaimers about it's not legal advice. Like people shouldn't just rely on this, but like I have things like a term sheet checker and actually like a Howey test tool, right? Like if you're thinking about doing a token, like it'll give you maybe a first sense of like, here are the types of conversations you might have with a lawyer.
Yeah.
And, like in terms of, I run a law firm, right? So I think about this from like wearing a business hat. I think over the short term, like it's incredible efficiencies. And like, I need to lean into that just to provide better and more efficient service to my clients. Over the medium term, it's going to change the fee structure, right? I don't know how long that's going to take, but I think it's not more than 1 to 2 years probably before that really changes, where you can rely on this enough to not have sort of uncertainty about billable hours. And then over the longer term, like, the library of skills I'm creating, does that eventually create a lawyer bot that has sufficiently learned all of the ways that I would think about things to do like a pretty good facsimile of what I do? Yeah, maybe that's possible, right? And, I want to be in front of that if that happens. But I think we're years away from that, both because of the privilege issue and just because like the universe of things, like even if you've got pretty well-trained legal AI on your side and I'm on the other side, like I'm going to find some way to fuck you over. Like the AI is not great at that sort of high level strategy yet.
Okay. The last thing I wanted to ask you about is prediction markets. We saw Selig, right? New commissioner of is that what's called? Commissioner of CFTC. Okay. I never know what their actual title is. I know what the
chair.
Okay, chair at CFTC. So he seems open to prediction markets. What is the current state of that specifically in DC? I know the gambling lobby is probably getting increasingly pissed. What's going on there?
Yeah. So the reason why the gambling lobby is pissed, I mean, similar to the conversation we were having before about banks and stablecoins just being more compelling product than banks. Prediction markets are a more compelling product than traditional gambling because you have capital gains and losses, right? It's a market as opposed to a binary bet where you have an income gain if you win and you can't write it off if you lose. So that's like the big arbitrage and partly why prediction markets are so popular for things that would otherwise be gambling. Separately than that, the thing that you're seeing with Selig is, this is something that's happening sort of across the Trump administration in AI as well as crypto, which is they're very worried about sort of the competitiveness of American tech firms and not wanting a patchwork of state by state regulation. And so a lot of the states, especially Democratic states, are very worried about gambling addiction and does this set bad incentives? It's a little bit ironic that like the Democrats who really aren't the party of like, religious puritanical virtue, look, I don't really have a firm view on gambling one way or the other, but it is an interesting position for them to take. The CFTC says, listen, this is our federal jurisdiction and states back off. You can't do state by state laws. They're going to make it impossible for tech firms to compete in the United States, sort of like we see in Europe. So that's another piece of this. And then there's the third part you didn't ask about, which is the insider trading. There's its own deeply complicated question, probably more than we have time to talk about here, but I would refer people to my friend and colleague Dan Barabender from Verint wrote a great Twitter article about under what circumstances is insider trading in prediction markets legal or not.
Yeah, that's interesting. I guess the last thing I would say is like, do you, looking at, basically Polymarket and Kalshi, obviously the two, leaders in the space. I know that Kalshi has gone the kind of regulated path, but regardless, both of them seem likely to be in lawsuits, or I think they are actively in the midst of this right now. Like, if you just had to kind of guess like how this plays out, do you have any? I mean, okay, the Selig seems pretty, okay with it, and like, yeah, he mentioned, I listened to him on this Odd Lots podcast, and he talked about, like, well, obviously you need to look more into the rules about what constitutes insider trading and how we deal with this, but for the most part, he seems to think that prediction markets are a very valuable resource, and yeah, there's some very good arguments for that. A lot of it does seem to be gambling now, so it's kind of interesting. But yeah, like, how do you, maybe if you had to guess, how does this kind of play out with, I don't know, maybe 5-year time horizon? Like, does this work out at all for prediction markets?
I'm going to hedge by giving you a conditional answer on this. I think unlike things like the line between a security and a commodity, which are very important for like crypto markets, but pretty impenetrable for most ordinary people. People understand prediction markets and people understand gambling. And I think it is both true that prediction markets provide very valuable crowdsourced data. I think that's not just a libertarian talking point. I think it's like actually very true.
Yeah.
It's also true that we've become a culture that's a little bit obsessed with gambling. If we're not going to gamble on shitcoins, we're going to gamble on prop bets. And I think public sentiment, because this is something that's easier to understand, will probably on a longer time horizon drive the way that either legislative policy from Congress, if they get that far, or sort of the executive branch regulates these things. And if the sort of use cases for prediction markets, whether to just gather good data or to like hedge out things in your life, I mean, I guess some of those like sound dystopian, right? Like you're going to do stuff with housing futures, as your way to like, that can get weird too. But if it's really useful, I think it'll stick around. If it ends up just being carnage, I think it's more likely to get regulated heavily if people sort of look at it, the way they look at vaping now.
Okay. Well, Zach, thank you. This has been fantastic. I really appreciate it. Thanks for coming on.
My pleasure.